All right, folks, so we've got Gordon Phillips back here on the YouTube channel. So we've just finished an interview with him on the podcast, and what a fantastic interview it was, I've got to say. So we've got him back on to actually walk through some stuff on the charts. So if you guys want to hear the full podcast, jump over to tradingnut.com and you'll hear the full, I think we went for about an hour-long interview with Gordon. Mm-hmm. But today we're going to go through some of the stuff he talked about on the charts and get this up on the YouTube channel. So Gordon, how are things there with you today? I know it's been 24 hours since we last spoke.
They're great. I was just speaking to you before we started recording today about the difference in time. I thought it's late afternoon my time. I thought it was in the middle of the night your time. So I'm happy to hear you didn't have to get up at the crack of dawn to speak with me. So that's good.
Yeah. I'm just a day ahead. That's the only thing I can tell you what the future holds.
Okay. So here we have. I spoke about divergence. Now, is this something that you were familiar with yourself, Cam? Do you think, or you think most of your people?
Ironically, I'm familiar with it because I've literally just, I went and asked my guys, I said, what do you want me to, I teach people how to build trading robots. And I said, what do you want me to build? And one of the guys came back saying, look, if you can do a divergence robot, then that would be great. And this is just teaching them how to build it. And so I've just literally just completed one today.
Oh, that's great. Good. Well, we'll have to talk about that a little bit. I got some projects I'd love to work with you on with regard to
cool.
Expert advisor development. I've been doing that for quite a number of years. But what we're looking at here is divergence, classic divergence. Now, I've got a special MACD indicator down here. The typical MACD uses the exponential moving average. That's what comes standard with MetaTrader 4, which gives you kind of a jaggedy, you get a lot of little kinks and bends in it. The weighted moving average gives you a much smoother, curvier, more like sinusoidal, sine wave type of line, just easier for visualization. And what we're looking at here is the price comes down and makes a low. Now, 99% plus of the time, the MACD will contour the price action perfectly. Whatever the price does, the MACD will do. So, and the MACD, of course, is looking at a 12, 26, and 9. It's taking a 12-period moving average, a 26-period moving average, subtracting the one from the other, and then taking the difference and taking a 9-period average of that. So it's a 9-period moving average of the difference between these two. So you've got a rate of change differential between two moving averages at the same time. And it does something very, very unique that most indicators don't do. It actually has a high predictive ability to see where price is going next because it sees conditions where price has just overdone something that it quote unquote shouldn't have done and is very likely to retrace from that. So having said that, the price comes down, the MACD comes down. The price goes up, MACD comes up. You see a little dimple in here, which we'll discount for the moment. The price comes up and comes down, the MACD does that. The price comes down and makes a lower low. Now, when I say we're not connecting specific candles, we're just generally looking at the price structure. This cluster of bars right here, which is on a 30-minute chart, this 2 or 3 hour period, the price came down, made a low, and headed up. And the MACD is smooth because it's looking back a maximum of 26 periods and taking the average. The MACD turns up. Now, if the MACD had continued to follow price action exactly as it usually does, this shoulder, the MACD, would be down here where my cursor is now, be way down at the bottom of the screen. It would be as much lower as this shoulder here on the left is, as this price action is from this price action. The MACD actually turned up significantly higher than its previous low. So this is bullish divergence. The MACD made a higher low. The price made a lower low, and this is indicating that this entire section of price action here plunged, where it plunged more deeply than it had before, is overdone, oversold, went down too far, too hot, too fast to the short side, and has a lot of buying potential or buying pressure and is likely to rebound, and that's exactly what it did right after. And it does it about 83% of the time, 80% of the time, once you get good at spotting it. Now, interestingly, if you look immediately to our right, and I can borrow these same trend lines, we have a divergence again. This isn't quite as good. Well, I'll have to use this trend line down here in the MACD area. But if I put this one right here, like this, now we see that the price made an ever so slightly higher high, pretty much the same high on the price, but the MACD didn't agree. So if the MACD again had contoured price action, we would expect this shoulder of the price action to be right up here, where my cursor is right now. In other words, right up here, with a line parallel to this one up top. If I pull these down right on top of each other, as I show my students, you can see that there's very clear divergence in the angle of these trend lines. So this is saying that this area up here, the price came up, came back down, MACD came up, came back down. Price came up, clustered around a little bit, went sideways, chopped around and dropped. The MACD followed it right back down, but it did it at a lot lower altitude. So this is saying that this whole price clump right in here, this little cluster of price, is overbought, went too high, and is more likely to come back down. That's exactly what it did. So it's very, very, very predictive. I'm not saying it's a magic wand. This isn't Nostradamus. Nothing here is 100%. It's all based on statistics. But this is a very high probability pattern. Now, there are many ways to quote unquote interpret it. One of the challenges I have with students is people tend to want to see things that aren't there, or I call it tea leaf reading. So what I do is I have my students look for only the very best, highest quality setups. And you'll see 3 or 4 of them a week. So if you're showing up at your charts for 5 or 10 minutes at a time, in other words, I can come over here and grab any of these currency pairs and just quickly drag them onto the chart, and I can sort through time frames quickly. And so in a period of just 10 minutes first thing in the morning, I can scan through and see if there's divergence on any pair, any time frame. And then I'll just jot it down on a piece of paper or on a spreadsheet, kind of a watch list. Now, if there's nothing on the 4-hour chart, and there's not going to be anything on the 4-hour chart for at least the next 3, 4, 5 bars, I won't even bother looking at the 4-hour chart the rest of the day. Ditto a 1-hour chart. Now, I can come in here and change the values of the MACD to, for example, I could cut them in half, or I could triple it. So or double it to say 24. Well, let me restate that. I could triple it to say 36, 78, 27. And that's giving me a virtual 3 times MACD. So whatever the charts are, the MACD thinks it's 3 times as long. So I can put on a 15-minute chart and have a synthetic 45-minute chart of the effective equivalent. So it lets me get into the spaces and to play with it a little bit and to fine-tune it. But that's basically what divergence is. Does that make sense to you?
Yeah, it makes sense. And this is the challenge that I've sort of been working my way through in the last wee while is well, actually probably the last couple of weeks is trying to work out. So the main issue I had was this is great, but then how do you actually pick that entry based on
okay, great question.
The confirmation that, like, so you don't know that thing's curved down and
sure. Yeah, so one thing that students think is that you have to have split-second timing. We're as currency traders, we're used to split-second timing, right? We're watching the mouse, we're grabbing the mouse with our hand clutched, like I was kidding with you earlier, like rigor mortis, ready to jump on the first pip that breathes, right? That's not the way this is. This is actually quite forgiving. So if I scroll to the right, and we're going to simulate real time, you see what the price did. The price came up, came back down, but you can already see the MACD starting to turn over. Now this is on a 30-minute chart, you see? Yep. So each one of these little whiskers here on the MACD is 30 minutes. So now we're starting to see, well, I'm about to get a crossover. All I have to do is watch it. Now if I come back 30 minutes later and the price was, let's say where my cursor is right here, when I come back 30 minutes later and the price is right there, but my take profit target is somewhere down here, it's extreme. I obviously can't show that without people actually, taking the course and being under non-disclosure. But it's very forgiving. Let me put it that way. You can get in. If I send a signal out, I do have an offer a signal service. If someone gets a signal and they're at work and they're not going to get a coffee break for 30 minutes, and they go log in and they look and the price is pretty much right where it was, and we're on a longer term chart, a 1-hour, 2-hour, 4-hour chart, and we're going for 70 pips, it doesn't matter if it's 2 or 3 pips away from the entry. It's just a minuscule variation based on how we calculate ROI. So the turnover is pretty easy to see. I mean, it's really as plain as the nose on your face that the MACD just turned short. The price is sitting up here. We're going to be selling right here at the crossover, or as close as we show up and can get to it. And then and we track the price down. And then the system, which I described kind of audibly a little bit earlier. Yeah. What we do. And it's
brilliant.
It's a great way to trade, and people don't have to sit in front of their charts all day. As I said earlier, you can just show up 3 or 4 times a day at your convenience, late at night after the dishes are done and the kids are tucked in. I have some students that would get up 15 minutes, start their day 15 minutes earlier in the morning, drag themselves out of bed, grab a cup of coffee, look at the chart for 15 minutes, then jump in the shower. Whatever works for the individual. We're just like, I think you used the word stalking, which I thought was really great. Didn't you say that, stalking?
I can't remember.
I thought you did. I thought you did.
Maybe I did.
It was the accent. I misunderstood you. That would be funny. But no, it is. We're like stalking price action. We're not trading. You don't have to be constantly trading to justify your existence as a trader. It took me a long time to realize that.
Yeah.
This is all about quality. It's a whole different ballgame. So I'll share with you some couple quick things. Here's something interesting. I call it proof of profitability. So as I mentioned earlier, it's a 2-trade setup. And we have an initial trade I call the market trade, and a second trade, the extension trade, which triggers in if the first trade wins. And typically my experience has been about 83%, about 81%, always a little bit less on the second one because it's a momentum follow-up trade. But basically, if you multiply those two together, you get 67% run win rate. The 1-2 punch, if you will, is a run. And that's roughly 2 out of 3, darn close, 66%.
It's good win rate.
Yeah, so if we find 4 good setups a week and we're trading at 2% run risk, that's 17 trades a month. It's 208 trades a year. We're going to win 140, lose 68, because that's 67% of 208. And if you subtract the losses from the wins, you have 72 net wins. Okay, and you're doing that at 2% each. And it comes out to 140, a little less, 143%, because I'm rounding to the nearest whole number here, a year, which is about 12% a month, and the rule of 72 will double your money every 6 months with compounding. And we take our profit target, our risk is based on equity. So even if we're in a drawdown, that's fine. We're not going for the higher number of the balance. We're basing it off the equity to be more conservative. But this is it's pretty hard to lose with a system like this, because you'd have to be doing horribly. I don't want to overstate or exaggerate, but even beginner students can find at least a 70-75% win rate. I mean, even 60%, because you're multiplying these two together, and all you have to do is get above 50% to break even. You see, and you're way north of that all the time. So. And then the other thing I wanted to show you was the trade calculating. And I put an imaginary price in here of 1.000. So I was kidding about the Mondo, the one world currency.
Oh, yeah, of course.
Trading against the dollar. But if it's a 5-digit and we buy, if this is the price line, this is the take profit line, it tells us we're going for 50 pips. The stop loss will be 150. The run net pips will be 100. And this gives us the take profit stop loss value for the market extension and stop loss recovery trades. Take our equity, pop in risk, tells us exactly what the value of a pip will be, and therefore how many micros to put on. And just for FYI, we get to see what the free margin is down here. But basically, this is all anyone needs, is use spot the divergence, make note of the time, make note of the price, you make note of your profit target. That tells you how many pips it is. You then equalize, normalize risk. So it doesn't matter if X, I call it X, if it's 50 pips, 39, 122, doesn't make any difference. We simply adjust the number of micros so that if we win or lose, we come out with 2%, +2, -2. We're trading at 1%, +1, -1. So it's very, very mathematical, the entire process. And I try to turn my students into robots. That's our goal, to become your own personal expert advisor.
Brilliant.
So I hope this was helpful, but this is what I do.
Yeah, so. Look, this is really sort of painted the pictures that you were describing on the podcast. So, guys, if you do want to hear more about that exit strategy that he uses, which is really unique, I've got to say I've not heard that in over 150 interviews with traders. That kind of approach. So Gordon does explain it in detail on the podcast, so jump over there. So what's the best way for the guys to get hold of you, Gordon?
Well, just go to the website I was just showing, Cam, which is wealthscienceuniversity.com.
Cool.
That's what it is. Wealth Science University is the way it sounds.com. And there's contact page, there's contact forms and so on. But just shoot me a contact email through the form and say, hey, I was on Cam's show. I'd love to learn more. And I'm happy to schedule a half hour. I have a scheduling service I use where someone can pick a 30-minute slot, and I don't charge for it. I'm happy to make friends, answer anyone's questions, complete transparency, whatever they'd like to know. And then if they want to sign up, they can become a student of Wealth Science University and get caught up with the training videos. The class started, the 2019 curriculum series started just 6 classes ago. So they can watch those. Yeah.
Cool. Okay, brilliant. Well, look, thanks very much for coming on here and demonstrating what you do. I'm
welcome,
sure
sir.
guys will have taken some insights and knowledge away from this. So, guys, reach out to Gordon if you get a chance, and there will be a link under this video if you want to hear that full podcast as well. All right, folks.
Okay.
Until next time. See you later.
Thank you, Cam.